So the fund has been around for 50 years. It is relevant today because of the strong returns that it has produced for our clients over that period of time. We have audited data going back 38 years that shows that the fund has returned 15.3% compound returns after fees per annum for those clients over that period of time, and that's a mixture of both the industrial segment of the market and perpetual stock picking.
And if you look at that 15% return, you've seen some significant market events in that period. You've seen the Volcker high interest rate, high inflation period of the early 80s, the market crash in 87, you saw the bond sell-off in 1994, you obviously saw the Asian crisis in 1997, you've seen the tech wreck in the late 1990s, September 11, and obviously GFC in 08-09. And even through all that, we've been able to generate a 15.3% compound return. We've been very active in the way we manage the fund. So we will not own certain positions due to basically either very low quality or overvaluation. We're happy to take those positions due to the work we do. Some of the work we've done in the past to highlight genuine value has been particularly on a stock like Harvey Norman in 2009, where the market was valuing the stock pretty much on net tangible assets. We hired an external consultant to go and value each one of the properties that Harvey Norman owns. It took a good 2 to 3 months. They confirmed what we believed was the actual value of the stock just on the land alone was $1.90 a share. It was trading at $1.90. So the market wasn't paying even for the retailing operations. So we took a very aggressive position in that. We bought up to 14% of the company. Today it's trading at $3.30. So they're the sort of things that we tend to focus on.
And we've had a very long history of very conservative investors running this fund, and that remains true today. We always look at the downside of an investment before we invest. And whilst we're looking to produce good returns for our clients, we won't do so by taking excessive risk. So we're looking for businesses that we understand. We've got a big team of analysts out on the road. They're seeing management all the time. We're doing a lot of work on balance sheets and cash flow. And we're looking for a distinctive part of the business that we can value and get a clear idea on valuation, so we know what we're paying for the stock. We're also often buying shares that are out of favour with the rest of the market. So I think that characteristics helps us deliver better returns than the market at lower risk.
We also tend to look in parts of the market where the broader market isn't looking. One example we can point to is our investment in Reece, which we bought in 1991. It was a small company then, plumbing supply company, very simple. Extremely well managed, great culture. The stock's currently trading at $30. We got $9.50 in dividends out of it in that period of time. Now, even to this day, it's a $3 billion company. No brokers look at it. So it's still large parts of the market where we tend to look around, where we'll do our own work and value it ourselves based on what we're looking for.
So some people would say that the industrial share fund's a bit of a dinosaur. But if we look over the last 10 years, the industrials has done the same return as the broader market, but at a slightly lower volatility than the broader market. For investors in the industrial share fund, however, they've received returns of higher than the market and the industrial segment, but at lower risk than both.
If we just characterise those returns again, if you go back to some of the first audited numbers we have on a unitised basis for the industrial share fund, 1979, if you invested $1,000 in 1979, and say we move 15 years ahead to 1994, around that time, so you've had a market crash in 87, high inflation, etc. The $1,000 in the industrial share fund is worth $14,000. If you just put in a simple index fund, all odds index fund, it'd be worth $7,000, or an industrials type index fund, it's $12,000. Now, if we go to February 14, so the most recent sort of audited numbers we've got, that same $1,000 in 1979 is now worth $115,000. In a broader industrials index type fund, it's worth $88,000. And for an all odds fund, so including resources, it's worth $44,000. So the industrial share fund, through the cycles, many market cycles we've had, has proven once again that it adds value through the cycle after fees.